Welcome back to The Boring Accountant. This channel is all about making the boring parts of tax, banking, investing and small business and turning them into simple practical steps, especially for Kiwis and small business owners. If that sounds useful, consider subscribing so you don't miss out on the next one. Today we're going to be talking about why a big tax bill might actually be good news. And here's the thing that happens in a lot of small business conversations. The year's gone well, revenue is up. The accountant sends through the financials and then the tax bill lands. And somehow then the good move evaporates. I want to talk about why that reaction is costing people money and what the smarter mindset actually looks like for small business owners. Now, before I get to the main point, I want to be really clear. There is no virtue in paying more tax than you legally owe. Claim every deduction you are entitled to. That means vehicle costs if you use your car or you for work, home office expenses if you work from home, equipment, tools, machinery, your accountant fees, which are deductible by the way, marketing, insurance, professional development, wages and genuine bad debts. If an expense was genuinely incurred earning your income, then keep the receipt and talk to your accountant. A good accountant is one of the best investments a New Zealand business owner can make. And they'll often save you more money. Claim everything you're entitled to. And then whatever tax remains, well, that's a signal you've had a good year. Now, you only pay income tax if you're making a profit. A $50,000 tax bill doesn't just mean that the IRD has taken $50,000 from you. It means you earned enough profit that $50,000 is what you owed on it. The alternative, no tax bill, means no profit. So, which would you rather have? New Zealand's company tax rate is 28%. For every dollar of profit the company makes, you keep 72 cents and the government gets 28. Paying more tax means that you are keeping more money. The two things move in the same direction, and a lot of business owners lose sight of this. They celebrate a good year on turnover and then feel deflated when the tax bill arrives. But the tax bill is just part of a good year. So here's where it gets really practical. When you apply for a business loan or a mortgage or an overdraft facility, the bank will look at your financial statements and tax returns. They're going to want documented, genuine income. If your affairs have been structured to minimize tax and the bank sees a business that appears to earn very little or no money, they will lend accordingly. And for farmers and rural operators, this matters enormously. Your banking relationship drives your working capital, your term lending and your seasonal financing costs. If the financials don't reflect the real performance of your operation, the bank can't support you in the way that you may need. Now, a business with consistent healthy profits and the tax bills to match has significantly more borrowing power. The IRD and your bank are looking at the same numbers. Optimize only for the IRD and you may find that the bank is not impressed. Now, for many, at some point you might want to sell the business or retire or bring in a partner. And when that moment comes, the value of your business will be assessed. Now, a business that has consistently suppressed its apparent earnings is going to be harder to sell. Buyers look at the same tax returns and the financial statements as a bank does. Clean financials and a track record of genuine profits command a better price and more confidence from the buyers. Short-term tax minimization can quietly destroy long-term business value. So what does it actually look like in practice? Pay your provisional tax on time. Late payment penalties attract use of money, interest and penalties, and they erode the benefits of a profitable year fast. Set money aside as you earn it. Keep a separate account and move a portion of your income into it. As a rough starting guide, it's somewhere around 20%. But you need to talk to your accountant about what fits your current situation. Now make sure you keep records. Separate your personal and business expenses and review your structure annually with your accountant. If you found this helpful, hit like so more people see it and subscribe to The Boring Accountant for more simple practical videos on money, tax, investing and small business in New Zealand. If you've got a question, drop it in the comments. I might just turn it into a future video. Thanks for watching. And remember, a healthy tax bill isn't a punishment. It's a sign of a good year. Till next time.